Welcome students. So, we were talking about the optimum credit policy in the previous class. We just started talking about the optimum credit policy, and I emphasized upon that every firm must have the credit system selling their product on the credit in the market, but that investment must be optimum, not neither too less nor too high, so that it remains manageable, it remains controllable, and it remains profitable for the firm. So, now here a $1 million question is how to decide the optimum credit policy, right. So, for deciding the optimum credit policy, first of all, what is the optimum credit policy? Optimum credit policy is the one which maximizes the firm's value or which contributes in the maximization of the firm's value. That is the optimum credit policy. We have seen in the credit policy changes analysis that when we were thinking of relaxing the credit policy, changing the credit policy, every time we saw whether it was a short term change or a long term change, that the marginal profitability must outweigh the marginal cost. So, if that happens, then certainly the receivables credit sales will be profitable ones and they will be contributing in the maximization of the firm's value. Now, we can use here again the analysis which we have been talking for the past quite some time, that is the incremental analysis. The incremental analysis can also be used while deciding the optimum credit policy, and under the incremental credit analysis we have to calculate the incremental rate of return on an investment that is equal to or greater than the incremental cost of funds used to finance the investments. That ultimately the incremental rate of return of an investment should be equal to or greater than the cost of funds used to finance the investment. At least there is no profit, there should not be loss. So, we should be able to recover the cost of the investment, means that is a total cost including the investment cost, the bad debt losses as well as the collection cost. Even if we are able to recover the cost and the profit is equal to that cost, still we can think of selling on the credit, because that way immediate profitability is not there, but aftermath effects are there, and as byproducts of the selling on credit, though the profitability is not there, but the byproducts are so high, so many, that increased presence in the market, increased market share automatically delivers the value, and everything will be contributing in the value maximization of the firm. So, here what we have to do is we have to use the concept of incremental analysis, that if we are selling on the credit already and if we want to expand the credit, then how much additional investment we want to make, how much is the incremental rate of return available, how much is the incremental cost of selling more on the credit as compared to the current level, and then finally we will arrive at a decision. It may be a situation that we are not at all selling on the credit right now, we are selling everything on cash, but we are thinking of selling on the credit. So, if we want to start the credit sales, again we have to take the help of the incremental analysis, and there we have to calculate the IROR, incremental rate of return. Incremental rate of return we must calculate, and that will be calculated with the help of two things. One thing is the incremental operating profit, which is here incremental operating profit, and second thing is the incremental investment in the receivables. How much incremental investment is required, and after considering the total cost of the increased credit sales, how much is the incremental operating profit is there. So, we will have to calculate IROR, that is the incremental rate of return, right. Once that is calculated, means we have to do four things. First thing is that incremental estimation of the incremental profit, how much incremental profit is there. Second thing is estimation of the incremental investment in the receivables, how much additional investment is required, how much additional profit is there, and then we have to compare that these two and calculate the incremental rate of return, that is ROR, that is incremental rate of return on the investment, and then compare the incremental rate of return with the required rate of return. right. There are the two rates of returns. One is the rate of return which is available from the say increased sales, that is available because of the market situation. How much is available? That if we are selling on the cash, this is the price. We are selling on the credit, we will have to obviously sell on the increased price. So how much the price we are charging will be determined by the market. Credit period will be determined by the market. Even the bad debt losses will also depend upon the behavior of the external factors, that is the buyers and channels of distribution. So it means the ultimately the available profit, available cost or increased cost, and that will be say helping us to calculate the incremental rate of return which is available from all this process of the increased sales. And then what is our required rate of return, right. So here the important thing is that the required rate of return, when you calculate the required rate of return, that is the required rate of return, right. What is this required rate of return? Some people say that it is should be cost of capital, that at least the, as we have seen in the previous example in case of the long term credit policy change, that the opportunity cost of capital there was how much, that is 20%. But I say here, or maybe some other experts also say, that the required rate of return should not be mere the cost of capital, but it should be something more, and something more means that is the premium for risk, that when we are selling on the credit we are taking the risk also. So if I am only recovering my opportunity cost of capital, I am not getting any premium for the risk, then why should I take the risk of selling my production on credit, then remain under the constant fear whether all the sales will be collected or part of the sales will be converted into the bad debts, or I will be losing the sales in the market because of the happening of the bad debts. So it means if I am selling on the credit, I am taking the risk also. So it should not be merely the cost of capital, it should be cost of capital. Say for example the cost of capital is 20%, then some premium should be there. For example, premium for the risk is 2%, so my required rate of return will become 22%. So in this case, when we are comparison of the incremental rate of return with the required rate of return, so that incremental rate of return which is available from the business by selling on the credit should be compared with something called as the required rate of return, and the required rate of return should not be only opportunity cost of capital plus some premium for the risk we are going to take. So if opportunity cost is 20%, premium should be at least 2%, that is a reward for risk, that is a reward for the risk. Say for example, if we are totally risk averse, we don't want to take any risk, we are zero risk takers. So what we do, if we have our surplus funds, we simply go to bank and we deposit those funds in the bank and we take zero risk, because we know that in the bank funds are safe and we can expect some minimum return on those funds. And if it is a fixed deposit, in today's scenario it is 6% we are getting minimum, and if it is the saving deposits, minimum 3% is assured to us without any risk, right. But if we want to earn more returns, then we will have not to invest the funds in bank, we will have to invest the funds. Say for example, people go to stock market, people go to the real estate and some other risk taking investment avenues. So if people are taking additional risk by going to stock market or by investing the funds in the real estate, so in that case why they are going out? They are looking for the higher rate of return than the bank rate. It means when they are taking the increased risk, they should be compensated for that by the premium for the increased risk. So it should not be 6% on the fixed deposit like as a bank rate, it should be somewhere 6 plus 6, that is 6% for the say opportunity savings or the maybe the cost of capital which is available from other alternative investments, and 6% should be the minimum risk or the premium for the risk which I am taking by say coming to the stock market or investing in the real estate. Same is the case here. When the firm is investing its surplus funds in the credit sales, certainly they should not be compensated for the opportunity cost of capital. Opportunity cost of capital is the safe investment, right, but in the credit sales they are taking different kind of the risk. Their say bad debt losses are expected to increase, their collection cost is expected to increase, so why not the premium for that? So that premium we will have to add into the opportunity cost, and then that total will become the cost of capital plus the premium for risk will become the required rate of return, and that required rate of return should be compared with the incremental rate of return with that additional investment, incremental investment in the receivables, and the profits available out of it, that becomes the incremental rate of return IROR, and IROR should be compared with the RROR. So that if the IROR is equal to RROR, the decision making parameter should be that if IROR is equal to the required rate of return, then at least we can say yes. But if incremental rate of return is less than the required rate of return, we should not invest into that kind of the credit sales, because that is not a advisable investment, right. Reverse happens if, for example, that incremental rate of return is more than the required rate of return, then it is a win-win situation for the firm, and firm should, without thinking twice, they should invest into the credit sales, and they should create a current asset in the balance sheet, which is called as accounts receivables, sundry debtors, accounts receivables, and important current asset after the inventories. So, it means ultimately optimum credit policy demands that firm should be carefully, judiciously investing in the credit sales, so that ultimately the investment is productive. That is not a loss making proposition. The investment is productive, useful, and that is increasing the overall firm's value, and that will happen only if the incremental rate of return which is available from this investment is either equal to the required rate of return or is greater than the RROR. So, it means deciding the optimum credit policy, we should take into consideration two important things: incremental profit and the incremental investment. How to calculate the incremental profit and incremental investment, we have already discussed in the previous class in the say example when we measured the credit policy changes. Maybe the short term same model was used, and in case of the long term also we calculated the marginal profit or the incremental profit, then the marginal investment or the incremental investment, both at the cost and the selling price valuation of the receivables, and then we calculated the cost, and then we compared the cost with the rate of return, the profitability, and finally we have decided that yes, cost is much less than the profitability available. In a way you can say that the incremental rate of return is much higher than the required rate of return. So, it means we can go for say relaxing the credit policy. Here also, in case of deciding the optimum level of current assets, same parameters will be used, and will be our decision will be based upon that you calculate the incremental profits, you calculate the incremental investment, consequently the incremental cost, compare these two, and then compare the incremental rate of return with the required rate of return, and then see that whether should I go for investing in the say credit sales or not, and the decision criteria is only one, that your IROR should be either equal to or greater than RROR. So, then only the investment can be made, and up to that level of the receivables can be created, up to that level of the credit sales can be created in the firm's balance sheet or by the firm, where the same criteria is met, or up to which level the same criteria is met, that incremental rate of return is equal to or greater than the say required rate of return. When the moment comes that when the incremental rate of return declines as compared to the required rate of return, there we should stop selling on the credit. There is no point selling on the credit, it is totally useless and it is not a advisable proposition, right. So, this is how we can decide the optimum credit policy. Now, we will take into account another important concept, and that important concept is the credit risk analysis. Credit risk analysis. This is very important, means as a student of working capital management, if you are a professional manager, or maybe if you want to become the professional manager tomorrow, and maybe it is possible that you are handling the management of short term funds in the firm in which you are working, then certainly you will have to do the credit risk analysis. It may be a situation that either you are working in a company who is a borrower in the market, or who is a borrower in front of the bank or in front of the supplier, or you may be working with the company tomorrow, or you are currently working in a company who is a lender in the market, and they who are either supplier or the lender in the market. So, in both ways this credit risk analysis is important, right. So, credit risk analysis of every manufacturing company should be done, whether that company is borrower, then the lender has to do that analysis, and if they are say again borrower, then they themselves should also be doing the analysis for themselves, because they know it that when they will go to borrow the funds from the market, then certainly the lender would ask certain questions, and those questions will be pertaining to the credit risk analysis. Because every lender who is going to lend either money or any material as a supplier or as a lender of funds, both are interested into the safety of their funds. So, their funds are safe, their sales amounts are safe, and finally they are going to get their funds back. Everybody is interested in that. So, in the capacity of a borrower also, in the capacity of a lender also, both ways for the finance manager, this analysis is important, this analysis is useful. So, what are the important parameters from the as a point of view of analysis of this credit risk analysis for the managers who deal in the management of the short term funds or the working capital management, right. So, for them the analysis is based upon the 4 important things, right. The important aspects of the analysis are operating structure of the firm, financial structure of the firm, managerial structure of the firm, and industrial scenario. These are the 4 important things should be there clearly in the mind of any person, whether he is a borrower in the market or he is a lender in the market. He should be very clear about these 3 important or these 4 important points of the say credit risk analysis. Now, what is the operating structure analysis? Under the operating structure analysis, we can take the help of say for example to analyze the operating structure of the firm, the help of the some you can call it as important ratios. Say before we talk about the ratios, I would talk to you about that how to go for the operating structure analysis, or maybe the operating management, how to analyze the operating management of the firm, or operating structure, how to analyze the operating structure of the firm. For that I would have a little discussion before we move to the different ratios which are important ratios to study the operating structure of the firm. When we talk about the operating structure of the firm, right, the operating structure of the firm is understandable or can be studied from where? Operating structure of the firms, we talk about the operations, right, we talk about the operations of the firm, and when we are talking about the operations of the firm, it means we are talking about the manufacturing firm, a firm which deals with the manufacturing. When we started discussion on this subject in the beginning, if you recall, I gave you certain assumptions that when you talk about the working capital management, you are talking about a manufacturing company, because in the manufacturing company only there is a need for working capital. In the services sector organizations, there is no need for the working capital as such, right. So, if you are talking about the working capital management or the working capital analysis, it means we are talking about a manufacturing company, and when you are talking about the manufacturing company, then yes, we are talking about the operations of that company as far as the operating structure of the firm is concerned, right. So, it means there is this special fundamental golden rule that look, if the operating structure of the firm is good, is strengthened, is strong, but the financial structure of the firm is poor, there is no need to worry about, because a strong operating structure will improve the weak financial structure. But if reverse happens, that a firm has a weak operating structure but strong financial structure, then that firm or the investment in that firm is highly risky, because a weak operating structure will eat away the strong financial structure, and slowly and steadily the firm will become sick organization, and the strong financial structure will become the weak financial structure. Their operations are already weak, and if the finances also become weak, ultimately there is no point for the firm to survive, to remain into existence, and firm will close down soon. So, it means always bear in mind that under the operating structure analysis, and the financial structure analysis. We are talking about the two analysis, operating structure of the firm and the financial structure of the firm. So, under the operating structure analysis, we have to see now that operations of the firm must be very, very strong. So, how you can say measure the operations of the firm? Operations of the firm means the operating structure of the firm and the financial structure of the firm can be studied from the profit and loss account, or another name of the statement is income statement, right. When you prepare the income statement, say for example, here it is the income statement. We have this statement like this, we prepare this statement like this. So, we call it as trading and profit and loss account, trading and profit and loss account, right. Trading account is the upper part, and after that the profit and loss account starts. Output of the trading account is gross profit GP, and output of the profit and loss account is NP, that is the net profit, right. So, when you prepare the trading account, what you take in the debit side? We take direct materials, we take direct labor, and we take the direct overheads, other overheads or direct overheads, right. We write like this: 2 direct material, 2 direct labor, 2 direct overheads. And in this side what we take? By sales less sales returns, and then is the by closing stock. So, total of this we do here, we put this total here, and we total balance both the sides, and difference of this minus this side, this minus this side is to gross profit, or it can be by gross loss, GL. So, it is your sales, then it is a closing stock, or and then it can be gross loss, and it is here direct material, direct labor, overheads, and it is a gross profit. So, either of the two will be there, either gross profit will be there or gross loss will be there, right. So, if you want to see the strength of the firm's operating structure, you simply look at the trading account, you simply look at the trading account, because trading account is the account of the operations of the firm. In this account you see what we are taking only maximum 5 things. One is we taking sales on the credit side, and how much we have not been able to sell in the market, that is still available with us, and that is called as closing stock. So, total output is on the credit side, right, and total input is on the debit side. So, how much input the firm has made in terms of the material, labor and overheads, that is clearly given here. How much output the firm has been able to have, that is the sales and the closing stock, right. So, then if the sales plus closing stock is bigger, this total of these two is bigger than the total input, it means the difference is the gross profit, right. And when you move further, you take this gross profit, that is by GP here, then by indirect incomes, all indirect incomes, and here this side you take 2 indirect expenses, right, and then the difference. For example, again here also we have this side which is bigger, so it becomes the total, here we have to again total it up, and then it becomes 2 net profit before NPBT, that is net profit before tax. So, this statement is enough largely to understand the operating structure of the firm and the financial structure of the firm. Trading account is exhibiting the operating structure or strengths of the firm, and profit and loss account, lower part, second part of the income statement, is exhibiting the financial structure of the firm. If the operating structure of the firm is strong, I am saying, and the financial structure is weak, for example, you have a gross profit here, but here, well, while you come down, you do not have the net profit before tax, but you have say by net loss, right, you have net loss here, nothing to worry about. Firm's operating structure as shown by the trading account is strong, their financial structure is poor. So, the say profit and loss account is exhibiting a loss, not to worry about. You can extend the credit to this firm and your credit is safe, or if you want to, go to seek the credit from any agency, you can explain your case like this, that look, my operating structure is very strong, my financial structure is currently weak, but I am sure that the strong operating structure will help me to improve my weak financial structure. How the operating structure means how much I am investing as a input, my output is say much more than my input, and I am into the gross profit. Because we are a manufacturing concern, the firm you are talking about is, that firm is the manufacturing concern. It means in a manufacturing concern, major source of the profit should be their operations. If they are earning profit from the operations, but because of some very heavy financial structure here, the interest cost is very high. For example, we say here that interest cost is very high, so your indirect expenses will go up, and in that case, if your indirect expenses are increasing, financial structure being very heavy financial structure, so here finally we have reported the net loss, right, we have reported the net loss. But I am sure that this GP will improve over a period of time, and I will be able to restructure my finances, and I have borrowed the funds in the past from the sources which are very expensive. So because of that, my financial structure has become very heavy, but my operating structure is very strong, I am earning gross profit from my operations. So this strengthened operations will help me to restructure my financial structure. I will replace my expensive sources of funds with the cheaper sources of funds. Slowly and steadily I will manage my financial cost, I will manage my indirect expenses, other indirect expenses also, and probably my indirect incomes also improve. So my financial structure will also improve, right. So the lender also will look at and would take a decision that yes, their major source of revenue should be the operations, and this firm's operations are strong because trading account is exhibiting a very strong picture because they have the gross profit. Coming to the lower part, it has become a net loss, or for example it is not a net loss, say we assume here that it is not the net loss, but say it is the net profit, to net profit before tax, but it is a very insignificant amount. This amount is not very significant, insignificant amount. So you should not get scared that our net profit before tax is very low, so our financial structure is poor, so I think people will not lend us. No, that is not the case. People should look at the manufacturing concerns, trading account and the operating structure, because major source of their revenue and profitability is the operations. So because in that case, say we are not a finance company, so our major source of the profit should be from the operations, and since gross profit is high, so I am sure that my low net profit or the net loss, I will be able to convert to net profit, significant high net profit, so there is nothing to worry about it. And if the reverse is the case, for example here you have the not the gross profit, but you have the gross loss. For example, you have a no gross profit here, you have the gross loss, right. But somehow while coming down here, we have not here the net loss, but the net profit before tax. We have now say net profit before tax. So it means you look at in this case, despite having the gross loss from operations, the firm is reporting net profit before tax. It means from where the net profit has come? This net profit has come from this source, that is the indirect incomes. And indirect incomes come from where? Say if you have surplus funds, you have invested those in the market, so interest on the investment, this is the one. Second, for example, the firm during their good days, they have constructed the buildings and those buildings are rented out today, so it means that rent is coming as a income. But you see, interest income, rent income, this firm is a manufacturing concern, this firm is not finance company. So that the interest income should be considered as a income from operations. This company is a manufacturing concern, so interest income is today, tomorrow it will not be, because this gross loss will slowly and steadily will eat this investment also, and this investment will also go down in the drain. We are not a real estate company that we have constructed the buildings, rented them out, and major source of our income is the rent from the buildings. We are a manufacturing company and major source of the profit and the revenue and the profit should be the manufacturing operations. So if this is the case, that in the upper part in the trading account the firm is reporting loss, in the lower part the firm is reporting the profit, in that case it is a very dangerous situation. But if the reverse is there, that in the upper part there is a gross profit, in the lower part there is a lesser profit or net loss, nothing to worry about. It is a very good situation because operating structure of the firm is strong, and a strong operating structure will improve the weak financial structure also, and the firm has a bright future. Second thing is, another important thing is that this gross profit, we have to check how much gross profit has to be there. Gross profit has to be there. For example, you talk about that if you compare these two sides are, say, we have sales on the one side and we have the expenses, inputs on the other side, and both the sides, whether you talk about the output, you talk about the input, both are variable in nature. So if your expenses increase, your cost of material, labor and overheads increase, you should be able to recover that from the market by increasing your selling price, right, and then partly through the closing stock also, which will go to the market tomorrow. So in that case, all the 5 items being variable, either the GP should be, say, depicting a rising trend like this, or not rising, so at least it should be having a, say, stable trend like this. GP should not have a trend like this. Gross profit should be there, and gross profit either rising or remaining stable. It should not be depicting a declining trend. If it is stable or depicting a rising trend, it means with the passage of time, firm is improving its operations are very strong, so strong operating structure will improve the weak financial structure. But for example, here gross profit is there, but the gross profit over the years, if you make the analysis of, say, past 3, 4 or 5 or 10 years, and we see that the gross profit is declining over the years, then again it's a very serious case to be taken care of, that here their operating structure is getting weak. And how it will affect the financial structure, I have already discussed with you. So about the operating structure of the firm and the financial structure of the firm, we have discussed something till now, and we will have to continue this discussion furthermore to arrive at to some logical conclusion, and that further discussion which we will continue and we will have in the next class. At the moment I will stop here, and in the next class again I will pick up about the operating and structure analysis, financial structure analysis, important ratios which can be used to study the operating structure and financial structure, as well as the managerial structure and the industrial scenario of the firm. All this we will discuss in the next class. Thank you very much.